Look at this trading floor. For most retail traders, this is exactly what the market feels like: chaotic, random, and driven by emotion. Every sudden price drop or spike triggers a panic. In the 1930s, a Japanese financial journalist named Goichi Hosoda, writing under the pen name Ichimoku Sanjin, began searching for a hidden order beneath this noise. Hosoda studied equilibrium. He believed markets reflect human behavior, cycling from balance to extreme imbalance before pulling back to center. To track this, he built the Ichimoku Kinko Hyo, the one-glance equilibrium chart, mapping trend, momentum, and support simultaneously. Instead of intersecting lines, the system provides a visual map of market equilibrium and human behavior. The foundation of the system is the Kumo, or the cloud. It acts as an immediate trend filter. When the price is above the cloud, the bias is bullish. When it's below, the bias is bearish. Next, we add the Tenkan-sen, or conversion line. This tracks the midpoint of the highest high and lowest low over 9 periods, measuring short-term momentum. Then comes the Kijun-sen, or baseline. Calculated over 26 periods, this line represents medium-term equilibrium. When price moves too far too fast, the Kijun-sen acts as the magnet price wants to return to. When the fast Tenkan crosses above the slower Kijun, it forms a golden cross, suggesting buyers have taken control. A cross below is a death cross, suggesting seller dominance. But look at this crossover happening directly inside the cloud. Is this a valid signal? In this system, the cloud represents a zone of indecision. Crosses here are often just sideways noise. A golden cross above the cloud is a strong alert, but taking the trade requires checking if the trend still has the momentum to sustain a move. Most retail traders use the relative strength index to guess reversals. They see the price hit the 30 or 70 levels and assume the trend must stop, only to get caught as the price continues to move against them. We focus on the level 50 midline instead. This turns the oscillator into a dedicated momentum gauge. When a golden cross appears above the cloud, the RSI should be above 50, but still below 70. This confirms the trend is accelerating, but still has enough room to move before it becomes overextended. Pairing the Ichimoku trend with the RSI midline helps identify entries that have the backing of momentum, reducing the risk of buying into a move that is already exhausted. Now we look for a fair value gap, or FVG. When a massive breakout candle forms, it can leave a structural gap between the wicks of the candles on either side. This area represents a price imbalance. Rather than chasing the breakout candle, we wait for the price to pull back and fill that imbalance. The high probability entry occurs when that fair value gap overlaps with the Kijun-sen baseline. This confluence marks the exact spot where the market's need to fill a liquidity gap meets its historical tendency to return to a balanced state. We can apply this to a 1-hour gold chart. We'll load the standard Ichimoku settings, a 14-period RSI with the 50 level marked, and a transparent FVG indicator. Gold breaks through the cloud resistance with a massive candle, leaving a clear fair value gap in the structure. The Tenkan crosses above the Kijun for a golden cross, and the RSI reads 58, confirming we have bullish momentum. We place a limit buy order precisely at the level where the Kijun-sen meets the 50% mark of the fair value gap. The stop loss goes below the Kijun-sen, or the cloud boundary, targeting a 1-to-2 risk-to-reward ratio. As the price moves higher, we can trail the stop along the Kijun-sen line to lock in gains. This strategy moves you away from reactive decisions. By combining momentum, liquidity gaps, and equilibrium, you only execute when the data points to a single point of confluence.